video, we're going to be talking about proprietary trading firms or prop firms versus retail trading. We're going to be clarifying the differences between proprietary trading and retail trading. We're going to be looking at some key differences between the two and looking at which is the best method of trading for you. Hey, and welcome back to Mindfully Trading. If you're new to my channel, my name is Emily, and on Mindfully Trading, I share my journey as I grow and develop as a Forex trader. I've been trading for around about 5 years now. I originally started day trading the US stock market with warrior trading, and since then I've gravitated towards day trading Forex. As well as trading Forex full-time, I'm also a full-time mother. So I have 2 children under the age of 2, and my second I had around about 3.5 months ago. So it's certainly been a busy year for me. So make sure that you're subscribed below to share the journey with me as I continue to navigate the realms of day trading Forex. And let's dive into today's main content, prop trading versus retail trading. Before we can compare the two, let's clarify what exactly proprietary trading is. So proprietary trading or prop trading involves financial firms trading stocks, bonds, currencies, or other financial instruments but using their own funds. Unlike retail traders who use their own personal funds, prop trading uses their own company capital. So if you are a prop trader, you are working with or for a prop firm and you are trading using the company capital. Whereas if you are a retail trader, you are trading using your own personal capital. Prop trading can encompass different trading strategies such as high frequency trading, algorithmic trading, and quantitative trading. These firms also have research teams and they have access to extensive market data for strategy implementation. So they have a lot more resources on their side than your average retail trader who is pretty much a one-man band. But let's explore more about the prop trading dynamic. Proprietary trading firms recruit traders to trade on behalf of their company. So they will recruit traders to execute trades on their behalf using their capital. These firms provide the capital, they provide the infrastructure, and quite often they also provide the training or some support or even mentorship to help support the trader through their trading journey. It's quite a symbiotic relationship where both the trader and the prop firm aim to profit from the market movements. Prop trading also promotes a collaborative environment whereby traders benefit from the strategies and the insights, often working together with the prop firm to promote profitability, which is what both parties want. The structure varies and it's very much dependent on each individual prop firm. Some prop firms even provide a salary and bonuses in addition to the profit sharing. I know that the prop firm that I trade with, the 5%ers, as you scale up through one of their programs, the high stakes program that I'm currently enrolled on, as you scale up and trade the large account sizes, that actually comes with the option of a salary and bonuses as well. If you want some more information about that, I have created a separate video which talks focusing on the 5%ers, and I've also got a link to them in the description below this video. Now let's contrast this with retail trading, which is probably the form of trading that most of you watching this now will be doing. And why is that? Because retail traders are individuals like you and like me who are trading their own personal funds in the financial markets. So whether you are trading a small sum, if you've started with just $100, $500, $1,000, $10,000, if it's your own money, you are a retail trader. Retail traders often use brokerage platforms. They use brokers to access and execute trades in the live markets. But the key distinction here is that retail traders are trading using their own capital, their own personal funds, not the company capital. But there are some other differences as well. So retail traders have the flexibility to use their own strategies. There are quite a lot of prop firms that have restrictions on strategies, but if you are a retail trader, you are your own boss, you have your own way of trading, you have your own strategies, and you also have your own way of managing your risk. Overall, retail traders are not bound by a firm's guidelines. However, the disadvantage of this is that retail traders also bear the full weight of any losses that they incur from their trading activities. And they don't get the benefits that also come with a prop firm. It's not just about the capital. A lot of prop firms have a lot of extra benefits. So one of the main differences that lie between prop trading and retail trading is capital resources. As we know, prop firms provide substantial capital resources to retail traders, which generally allows them to take larger position sizes and potentially generate some more significant profits. Whereas retail traders are limited to their own personal funds. With the 5%ers, their high stakes program, they have a range of different account sizes that you can choose from. And the reason that they do this is because it costs money to carry out one of the challenges with them. And if you start off with the smallest account size, it's the cheapest option. But if you have some more capital that you are happy to invest in this way, you could purchase one of their larger account sizes, which costs more, but then ultimately gives you the ability to generate more profits if you are able to pass their challenge. The capital that's provided by prop firms enables traders to diversify their strategies and take advantage of the market opportunities that may be out of reach for retail traders who have limited funds. Another major point to consider in the difference between prop firms and retail traders is technology. Prop firms invest heavily in technology. They offer advanced trading tools and algorithms to their traders. This tech-savvy environment gives prop traders more of a competitive edge, whereas retail traders who may have access to sophisticated platforms might not have the same level of technological infrastructure as prop traders. So some of the cutting-edge technology that prop firms may have access to includes direct market access systems and co-location services, which means they're able to execute their trades with minimal latency. This basically means that a lot of prop firms have the technological advantage to allow prop traders to execute their trades much more quickly and much more accurately than retail traders, which means that you could get into a position more accurately with little slippage, and just gives you that little bit of an edge over the markets. And it ultimately means that traders can capitalize on the market inefficiencies rather quickly. Now let's talk about another interesting aspect here of prop firms, and that is the profit sharing models. In prop trading, there is often a profit sharing model where both the trader and the prop firm take a split and ultimately share the profits that are made on the account. This ultimately aligns the interests of both the trader and the prop firm. Whereas in retail trading, the trader will either keep all of the profits or they will bear all of the losses because it's your personal capital at stake. This method of profit sharing fosters a collaborative and performance-driven culture within the prop trading firms. Ultimately, the more profitable the trader is, the more profitable the prop firm is. It's a win-win situation. The model motivates traders to continually grow and develop and improve their skills and their strategies. An often overlooked aspect of trading, but a super important aspect of trading, is risk and leverage. Risk and leverage are critical considerations, and prop trading firms manage risk really closely. In fact, traders often operate underneath very strict risk management rules. More often than not, this is why it can be difficult to pass a prop program, a prop challenge in the first place, because you have to adhere to some very tight rules when it comes to risk. And if you are not the kind of trader who prioritizes risk, this could be a little bit more difficult for you. But risk management and managing your risk effectively will always improve your ability to make more money as a trader. In retail trading, the trader has more flexibility, but also more responsibility for managing risk. Ultimately, if the retail trader, the one-man band, doesn't manage their risk effectively, this is going to end up with a one-road route to account destruction. Also, leverage can vary widely amongst brokers. So depending on what broker you are with, if you are a retail trader, it will also vary on how much leverage and buying power you have to trade with. Prop trading firms often have risk management teams, and these are teams that will monitor traders, their positions and their exposure in real time. So they will make sure that you are adhering to their risk management rules. But this can be really good if you are a prop trader because it makes you accountable and it means you have to follow the rules. But the rules are in place to really help to hone your trading skills and your ability to make profits. It's important to remember that whilst leverage can amplify profits, it can also magnify losses. So leverage is a double-edged sword and you do need to be really careful. And there you have it, a breakdown of proprietary trading versus retail trading. Both have their unique advantages and their challenges. And as we've explored, the main differences between the two comes down to capital and risk management. If you found this video informative, don't forget to hit that like button, subscribe to the channel below if you're not already subscribed. Any questions, do leave them in the comments and I'll catch you in my next video. Thank you for watching. Bye!